How's it going, everyone? Welcome to Day Trade Smart. We're going to get started here today with a new webinar that we're starting here for Fridays. It's going to be called The Sweep, but essentially what we want to do is we want to take day trading and break it down for you, especially for those that have never day traded before. We want to start from the beginning. So this is going to be, this first set of videos is going to be in multiple pieces. We're going to do the first part today, just kind of a teaser, build up to what we have in store for you. So definitely subscribe to our YouTube channel. That's youtube.com/theprovingground. Also you can follow us on social media, facebook.com/daytradesmart, and on Instagram at daytradesmart1. So definitely do that, and let's go ahead and get into it. So we wanted to talk about the topic, what is day trading? It's a question that we get quite often, and there's a lot of miscommunication and misinformation as to what day trading is exactly. And we're going to just kind of take this at surface value. We're not going to get into, a lot of the lingo or anything like that. We just want to be able to explain it in a way that is palatable and that people will be able to understand and grasp. So let's go ahead and get started. And what we're going to start with is, we can start by basically stating what day trading in terms of its definition is. So it's just referring to the practice of purchasing and selling a security in any marketplace. So day trading is most common in the foreign exchange or forex and futures markets. Now, a lot of you guys that are just getting started with day trading may attribute it to what you might know about stocks. So for the sake of these examples, I've just kind of made that correlation, day trading versus stocks or traditional forms of investing. So although one can day trade the stock market, most people who are familiar with the concept of day trading compare it to what they know of purchasing stock, 401k, mutual funds, etc. Right? And so some of you guys might have some of those or have had some experience with those, right? So what are the differences then? What's the difference between what we do in day trading and your traditional forms of investing or even purchasing stock and holding for long term? So where stocks and traditional investing rely on having a firm manage your investment, day trading allows you to take control of your investment and cut out the middleman, right? There's one thing, if you let somebody else manage your investment, the one constant is going to be that individual will get paid. Whether you win or lose money, that individual will get paid. Now they've got all kinds of algorithms out there that basically tell them exactly where and how to put your money, so there's nothing unique to you, maybe a little bit riskier if you choose, or less risky if you choose, whatever it may be. But for the most part, there's an algorithm that kicks out and tells them exactly what to do. But for you, it doesn't give you any additional assurances. And although traditionally over a long period of time, say between, when you first start working maybe at 18 or later on when you get wise at 25 and you start investing to the day that you retire, hopefully that's moved up significant enough that you can live comfortably in retirement, which isn't usually the case, right? We know that over the last 10 years that hasn't been the case for a lot of people, especially with what we've seen in 2008, in 2016, and then again here in 2020. Where people are really taking some dives in their long-term investing. So what is the alternative, right? And for a lot of people, it is day trading. It's taking that control into their own hands as a retail trader, and that's what we're referred to as when we're trading as day traders, are retail traders. So when a stock is purchased, the concept is to purchase a stock at a low price, hold the investment for a long period of time, say 5+ years, and hope it's worth more when you decide to sell it off for profit, right? So day trading gives you the ability to place buy trades when the market is moving up and sell trades when the market is moving down. So it's bubble proof. It doesn't matter if there are recessions or there's a burst in the in the market, like the housing markets, things like that. It just depends on your analysis of that particular asset or security and which direction you trade it. So you can make the same amount of profit if the market is going down as you can when it's going up, because you're speculating a position. You're speculating that it's going to go up or it's going to go down, and that's where you're putting your money. And now this is a zero-sum market, and that's something we'll talk about later. So essentially, how are you getting paid, right? Because with a stock, it's the value of that stock that actually pays you. where what we're doing in these speculative markets is we're playing a zero-sum game, right, or a zero-net game, where there are winners and there are losers, right? Well, the losers pay the winners. And that's essentially how this game is played. Now, there's millions of traders around the world, so there's always somebody buying and selling. So you always have the ability, virtually always have the ability to be able to get into some of those positions, especially when we're looking at markets like the Forex market. And we'll talk a little bit more about that later. Traditional forms of investment are often subject to withdrawal limitations until you've reached a certain age or the investment has matured over years, right? So profit from day trading is completely liquid and available for withdrawal once all active trades are closed. So if you went into your trade account today and you placed a trade and you won that trade, that's liquid. That's dollars in your pocket. It's as good as being in the bank. You request withdrawal from your broker. That money gets sent to your bank account, and now you can use it for whatever you'd like. So it's definitely a lot more pliable than it is when you have your traditional forms of investing, where you have to reach a certain age of retirement, or that investment has to sit there for a certain amount of time. This is different than that. It's liquid, so it's something that you can do for a living, right? And the idea is that you don't exchange one 9 to 5 for another 9 to 5. In other words, if you're going to start day trading, what's really valuable about it is that you can do in just a few hours a day what it would take you to do in an 8-10 hour day, right? In terms of building wealth and supplementing, replacing your income, whatever it is that you're looking to do with day trading. And the sky's the limit, right? There's nothing, no one's going to put a restraint on you as to how much you can earn. So that's definitely going to be some of the pros to day trading versus your traditional forms of investing or buying stocks long term. Traditional investing sometimes requires you to continually feed the pig, right? So this is by contributing additional funds each month. We see this really common obviously in 401ks and IRAs, mutual funds, where every month you got to continue to put into that, right? It just comes right out of your check and you put into those investments. So this is not necessary with day trading. As long as you have money in your brokerage account, there's no need to continually deposit in order to grow your account. As long as you've got enough in there to trade with, then you can continue to place trades and earn money on that. Now, the idea is that whatever your capital is, whatever your initial starting balance is, you don't ever want to have any periods of time where you are below that initial starting balance for long periods of time. Essentially, you want to use money management in order to get yourself to a place where you are compounding your earnings and your growth, so that initial investment, that seed money, is used to continue to leverage and grow, and then whatever extra money you've grown is also used as leverage to grow your trades and so on and so forth. Now, when we look at day trading versus stocks, they would have to continue to go up, right, up and to the right, in order for you to continue to make money. With day trading, if you've got a setup, say you've got a setup that you can acquire a certain, certain increment of movement. Let's just say the Forex market, and we're using pips, and we'll explain pips later as well. But if you put in a 5-pip trade on the same account and you had a winning strategy, over time, if you're using money management, and let's just say you're risking 1% of your account, that same 5-pip trade will be worth more and more as time progresses. You don't have to change anything about it. You don't have to try to acquire more movement in the market. It's the same thing over and over, but because your account is growing and you're risking a percentage of that account, then each trade is worth more, even though nothing has really changed about the trade or how many increments of movement you've taken out of the market, but rather the value of each increment of movement. Now, in addition to being required to add additional funds to most traditional forms of investing, for some forms there are large initial deposits required to get started. So although it is recommended you begin a futures account with $25,000 and a Forex account with $2,000 or more, you can start trading with as little as $100 USD on Forex accounts. So you can literally go to a broker, and some of them just say, look, your minimum deposit is $100, and with that $100 you can use this maximum lot size, and you can start trading with as little as $100. I wouldn't recommend it. I would recommend at least $2,000 for a Forex account, and futures, the recommendation, of course, is 25,000 minimum. So anything beyond those numbers. So comparatively, you can see that it is a lot less taxing to get started in day trading. So how do you get started with day trading? So there are no licenses required for individuals interested in day trading the financial markets. The following steps are highly recommended before risking real money in the market, however. Right, so you don't have to go out and get any of these series, 5, 6, 7, 11, 23, none of that stuff. If you're going to be trading your own money, you don't have to have any licensing for it. So what do you need to have? Well, number one, you have to have proper education. And not all day trading is created, education is created equal. Right? So you've got to make sure that you're picking correctly. And we'll get a little more into that later. But once you've got the proper education, you know exactly what you're doing, and you're ready to go, then it's pretty simple. You deposit a minimum of $2,000 into a brokerage of your choosing. Let's say you're going to start off with Forex. So we do not make broker recommendations, but in the later session we'll talk to you about what to look for when choosing a broker. Right? So we're not what's called an IB or an introducing broker, and we never will become it. It's not difficult to do it, but we won't, because for us it creates a conflict of interest between us and our members of Day Trade Smart. So because of that, legally, we can't make broker recommendations. We can't say, hey, you should go to this broker or that broker, whether they're paying us or not. But generally speaking, IBs, or introducing brokers, what they'll do is refer you to a broker that they get a kickback from every time that referral signs up for their services. So we don't get any kind of kickbacks from brokers or anything like that, and we don't make any broker recommendations. We're very strict about what the CFTC rules and regulations are, and if it's gray area and we're not certain, we just stay away from it. Where this is not gray, this is very black and white. IB, we are not, so we don't make any recommendations for brokers. But that being said, again, we will go over in a later segment what to look for when choosing a broker, because there are some things you want to be aware of. There's some things that could potentially get you into trouble, other things that are more optimal for trading depending on what your strategy is and the like. So after that, your third step is start making money on your terms, right? So you've got your education, you know exactly what you're doing. You've deposited it into a brokerage account, and now you're ready to start making money, right? And it really is that cut and dry. So obviously, when we look at this, what out of this would be not necessarily in your direct control? Well, right now, if you're just looking at day trading, you're probably seeing a lot of videos like this and other videos where they're talking about their strategies and so on and so forth. So how do you determine what proper education is? Right? That's kind of the part that may not be in some of your control, because you don't really know what to look for. And so we're going to talk about a little bit of that today, right? Just a little bit. It's just kind of a teaser. But there are some things within vetting and within proper education that we will cover with you, but it's thick. It's not something that we can cover in a small segment. So I want to break it up so that we can deliver it to you in a palatable way, something that you're going to be able to replicate. It's duplicatable, right? All right. So proper education. Let's start by stating facts. Okay. Over 95% of individuals such as yourself who attempt to day trade fail. Over 95%. This is a fact, right? You guys can look this up. Over 95% of individuals that attempt to day trade fail. Now, we do know that within day trading, this industry is making more millionaires a year than any other industry, right? But there's that fallout process where most people that try to day trade fail, right? And there's some silver lining, right? There's light at the end of this tunnel, right? Because that's overall millions and millions of traders, but there are organizations out there that are able to take their students and have a better conversion than that, right? They're 95% of the students are not washing out, right? And I do want to preface by saying right now I'm going to be very careful about a couple of things. I'm not going to make any kind of income claims. I'm not going to claim that even if I can prove it, we're not going to claim anything about our students or their success or lack thereof. For one, You wouldn't know if we were telling the truth or not anyway. But for two, it's irrelevant to you. It really is irrelevant to you specifically, because just because someone else can do it doesn't mean that you can do it. So I'm just going to use a quick analogy. Let's say, for example, that you knew nothing about the sport of basketball. You knew nothing about it. You just you didn't know that there's the NBA. You didn't know that people got paid lots of money to do that. And I was selling you on the concept of playing this game that you can make millions of dollars and become famous by doing. And I can show you example after example after example of players that play this game, right? And they make millions of dollars, right? I didn't show you what they had to do to make this. I didn't go and show you how their physical physique is, how they can dunk, how they can dribble, how they can run fast. So I just showed you this person makes this much money playing this sport. So let me teach you how to play this sport. And because all these other people do it, that means that you have a good chance of doing it too. Well, knowing what you know about basketball, you know that's not the case. Basketball is one of those things, like singing or any other professional sport, that you have to kind of be gifted, right? Like if you're going to be a famous artist, you got to be gifted. And so if you're going to sing, if you're going to play a sport to a professional level where you're making millions of dollars doing it, you've got to be born with something. Right? It's not. Not everyone can do that. Day trading is not like that, by the way. Right? We know that. You don't have to be born with something. You don't have to be good at math, any of that kind of stuff. There are a specific set of rules, and if you follow those, then you'll be successful at day trading. That's the light at the end of the tunnel. Right? Now, over 95% of individuals who attempt to day trade fail, and there's reasons for that, and we'll get into that. So the most common win rate for day traders around the world is 50% to 55%. So this means that half to just under half of trades taken in the financial markets lose money. So how do people make money then? If over 95% of people that try to day trade never become professional day traders, they fail at it, right? And the ones that are succeeding are winning at a measly 50 and 55%. You can probably get the same with flipping a coin and deciding which direction to trade, right? But there are some reasons that, and we'll dive into that here in just a moment. So here's another one. It takes an average of 5 to 7 years for most day traders to figure out how to day trade profitably, then an additional 1 to 3 years to earn a significant profit. So why am I starting off with this? Am I trying to scare you away from day trading? No, not at all. You're definitely in the right place. All right, but I show you this because I want you to see that there is this dichotomy between firms that are going to teach you the right way of day trading and the vast majority of organizations out there. And this is the truth. And anybody that's ever day traded or anybody that's ever looked into day trading for any period of time can attest to this, that most of what's out there is garbage. It doesn't work. It's somebody that's looking to sell you something that is worthless, and but they want to take advantage of the fact that you don't know the difference, right? So that's why I want to point these things out, because first, these are things that you can validate, and along this process, you'll realize really quickly that I'm going to make sure that I'm equipping you with things that allow for you to vet not only other organizations, but what I'm saying as well. Right? Because it breaks down to just math and science. And when I explain this to you, for those of you guys that have looked into day trading, you're going to wonder, why have you never been told these things? Right? And if we've got time, I'll explain why. I'll explain some of the reasons why you've never been told some of these things. So let's move on. So the primary reason for these and many other epic failures are attributed to lack of proper education within the industry. There is a huge lack of proper education within the industry. When I first got started in this industry, there was nobody to explain anything to me. And, my business partner and I, Tim Coblin, we're co-owners of Day Trade Smart. And we had to figure it out for ourselves. We had a tool that worked really well, the best that we had seen. But there were things that we needed to know that were beyond just the tools, beyond just taking a trade or knowing how to place a trade or what a pip meant, There was a whole world of things that we had to work really hard to figure out. And once we figured those things out, then it became very evident that this was not only going to be very prosperous for us, but it's duplicatable. It's something that we could teach others, and they could do the same and have the same or greater level of success than we've had. And so let's go on. So furthermore, the vast majority of day traders in the industry, yes, even the successful ones, are using outdated and inaccurate tools, right? So this is in addition to the lackluster education. This is why it took them that long, even the successful ones, to become successful, because they had to kind of figure it out for themselves, right? And later I'll explain to you why and how that is in just a little bit. But in addition to that, it's the tools that you use that are going to either make the job expedient and efficient, or it's going to be a long, painful, drawn-out process, right? So we'll use this analogy later on as well, but consider if you were building a house and you had a hammer and nails and a shovel, versus a nail gun and a backhoe and a tractor, right? That's the difference in some of these approaches, is that in one instance, you may have everything you need in order to build that house, including the knowledge and the plan, but the tools that you have are not very effective. They're not very efficient, right? They're outdated. Right? You're not gonna see home builders that are worth their salt using a shovel to dig out their foundation. Right? They're going to be using tractors, and they're going to be using the best tools. And if you have the best tools at your disposal, you're going to choose that. The difference, and we always use this analogy, the difference is like going from New York to California through horse and buggy or through a jet plane, right? Which one's going to get you there faster? It's significantly faster, right? Some of you may not make the journey if it meant you had to walk there, right? Others, perhaps you may try and fail, right? And maybe a few would make it, right? But if you had the option to take a plane, which if we didn't have the option nowadays, we just wouldn't make that trek, right? Then we had the option to take that plane, then we would take the plane if that was the option, horse and buggy or jet plane, right? Unless you're trying to prove something, in which case, you're probably not in the right place. But if you're looking, for what you have yet to find yet, or you don't know what you're looking for yet, you're definitely in the right place. And I'll show you really quickly why. So let's consider this, right? What are they using? They're using things like EMAs, which stands for exponential moving average. That's an indicator, right? Or MACDs, moving average convergence divergence. MA, moving average. ATR, average true range. ADMI, average directional movement index, right? What do these all have in common? They're averages. They're average. So what do we talk about? What's the win percentage in the market, right? In the industry. Millions of traders around the world. What's their average win percentage? It is 50 to 55%. It's average, right in the middle, because of the tools that they're using, right? And these tools have been around forever, and they're just giving you the average. So you can win 50, 55% if you know some of these other facets that we'll talk about, like money management, things like that. But you can see why it takes 7, 10, and beyond years to get to a place where now you're making a significant amount of money. You've supplemented your income, you replaced your income, you build wealth, you're ready to you've stacked your retirement, right? Whatever it might be, that's why it takes them. That's part of the reason why it takes that long, right? And that's after figuring out how to day trade, right? That's the 3 years, 2, 3, 5 years after that point that is attributed to this. Because the tools that you're using they're outdated, and a lot of these tools here that we're looking at, EMA, MACDs, ATRs, there are other indicators that dress these up in different ways so that they look different, but really it's the same stuff. It's the same stuff, just dressed in a different costume, right? So some of the other things, so delayed indications like support and resistance. And don't get me wrong, if you use support and resistance and it works for you, great. But I doubt it. I doubt it works for you. If you're here You've either never tried it or you think that you figured something out with it, but you really haven't. And that's okay. That we want to make you aware of the fact that what a lot of people out there are saying is not true. You need to do support. You need to, trade support and resistance. If you're not using support and resistance, you're not going to be successful. You need to trade the trend, right? The trend is your friend until the end or until it bends, right? Candlestick patterns, what the candlestick looks like after it ends. Price action, right? Okay, think about these things. They're delayed indications. Why are they delayed indications? Because you don't know support and resistance is support and resistance until it's already formed. Trend, you don't know the trend is a trend until it's already formed. How do you know when it's going to bend or when it's going to end, right? Candlestick patterns, they're only good because they've already formed, right? Plus, with candlestick patterns, a lot of times by themselves they're not enough. You still need some other type of indication. Just like with any of these, actually, support resistance, you would need some indication to whether or not to buy. Usually it's like an H1 reversal, which stands for 1 hour reversal. And the most common 1 hour reversal are price action, right? And we're not going to talk a lot about this stuff. If you guys want to learn this stuff, you can go somewhere else. I'm not going to waste your time. I'm not going to waste your time. This stuff wins at 50, 55% unless you know how to use money management and backtest it, which is a nightmare. Good luck to you. Right? I'll see you in 10 years, and hopefully you made the trek from New York to California, and you're still alive and you're trading, in which case I'll shake your hand, and I'll tip my hat to you, and I'll be thoroughly impressed. I really will be. I've met these people. I know these people. I've gone to International Traders Expos and money shows and have talked to people that are successful day traders that had to do it the hard way, the 5%ers, right? It's more like 3%ers, but, the small few that have been able to make day trading successful, and their stories and how long it took them to get there. Now, would they go and use my program? No, because they've already done the work. They've already got something, but I always ask them, if you could go back and you could use what I'm using, would you do it? And I've never had anyone say no. And these are people that make millions of dollars in the market, but they don't. Of course they wouldn't. If you had the option for a jet plane versus a horse and buggy, you would take the jet plane. But they got there with horse and buggy, and they learned a lot. And now they've got their process down, and so they just rinse and repeat, right? So here you are at the starting line, right? And you've got a choice to make. How do I want to get from point A to point B? You want to make sure that you start on the correct path. And if this is the first stop, if this is the first experience you've had with day trading, you're probably going to move on, and you're going to move on to other things, and you're trying to find something that's simpler. But I'll tell you that there are disciplines that I will point out, and later in other segments we'll actually dive into deeper that will show you exactly why and how day trading is done, and why and how other forms are failing at 95+%, right? Okay, so let's debunk a few things here really quickly. This is some of the misconceptions that you might have had or have about day trading. And so I want to get rid of these really quickly so that we can start speaking the same language. So more movement equals more profit. So what is worth more, 100 pips or 10 pips? These are statements that people have made, right? More movement equals more profit. Maybe not in those words, but you'll get shown something. Look at all this movement we had, or look at, I took this many pips, or this much, and so on and so forth. And you assume, wow, that they got in really low and they got out when it was really high or whatever. They must have made a bunch of money. They must be rich, right? Well, what is worth more, 100 pips or 10 pips, right? And pips are just increments of movement in the Forex market. We're just going to use that as an example because it's usually the easiest. So what would be worth more, 100 increments of movement or 10 increments of movement, right? So let me help you answer that question. And really the answer right now is it depends. It depends. So let's look at some examples. So let's say we have a $10,000 account. We've taken 10 trades at 70% win rate. Okay, so 7 out of our 10 trades won, right? And we have a $10,000 account. So on our first trade, we used a risk-to-reward ratio of 2-to-1. That means that our stop loss was 200 pips and our take profit was 100 pips, okay? So we wanted for the market to go up 100 pips before it went down 200 pips. Now, at a 70% win rate, this is a profitable risk-to-reward ratio. We're not going to talk about how and why right now. That's a very in-depth conversation, and we will be having that, but not right now. It just takes too long. So I've got a segment that is dedicated specifically to that we're going to include in this series. Now, our risk percentage, because we're going to talk about why our risk percentage is 1%, because you don't want to just decide half-heartedly what that is. You want to use math and science. So because our win percentage is 70% and our risk reward is 2-to-1, we're going to use a 1% risk. So our goal is 100 pips. Our stop loss is 200 pips. 1% of a $10,000 account is going to be $100. We're going to risk $100. Okay. Now trade number 2 is a 2-to-1, just like this one, but it's for a 20 pip stop loss and a 10 pip take profit, because the question was, what is worth more, 100 pips right here or 10 pips right here, right? So how do we figure that out? And our goal here is 10 pips. Now our risk percentage is 1%, so everything is the same about both of these trades except for what our goal is. Here it is 100 pips and here it is 10 pips. Okay, so everything else is the same. All right. So right here we've got our first trade, and because we're risking 1% of a $10,000 account, that is $100 that we're going to be risking. So if we're risking $100, then if we hit 200 pips of stop loss, then we would lose $100. So that tells us what our lot size should be. In other words, how much each increment of movement is going to be worth. In this case, a 0.05 lot, which is 50 cents per pip per increment of movement. And you can see that 200 pips times 50 cents equals $100. $100 is 1% of $10,000. Okay, so that's how we break that down. All right, so if I took 7 trades and I won them for 100 pips each, then I would have 700 pips. If I took 3 trades and I lost them for 200 pips each, then I would have lost 600 pips for a net of 100 pips. Now, what is my 100 pips? So these were 10 trades, right? We said we're going to take 10 trades. So if I made 100 pips out of those 10 trades, how much is that worth? Well, my lot size would have been 0.05, 50 cents per pip. So 50 cents 100 times equals what? $50, right? So we would have made $50 in 100 pips. Now let's go to our next example. Right here we have the same thing, right? 1% $10,000 account, so we're going to risk $100. So here we have a 20 pip stop loss. So that means that what lot size would we use that would equal $100 in 20 pips? That would be a 0.5 lot size, which is $5 per pip. $5 per increment of movement, right? Because 20 pips, 20 increments of movement times $5 per increment is $100, right? 5 times 20. And $100 is 1% of 10,000. Okay? So we took 7 trades here as well. This is the exact same, right? 7 trades, and we won 10 of them. Or 7 of them, sorry. We took 10 trades and we won 7 of them for 10 pips. So 7 times 10 is 70, right? And we lost 3 of them, minus 60, because there were 20 pips was our stop loss. And we lost 3 of them because we wanted a 70% win rate. So what was our net pips? Is 10 net pips. But what is our lot size for each of those? 0.5, which is $5 per pip, right? And $5 per pip is what? $50, right? $5 per pip for 10 pips is $50, right? 5 times 10. So let's look at a side-by-side then. Let's break this down. Here, trade 1, our goal was 100 pips. Trade 2, our goal was only 10 pips, right? Our lot size on that one was 0.05, and our lot size here was 0.5. 0.05 is 50 cents per pip, and 0.5 is $5 per pip, right? We won 700, and we only won 70 here. We lost 600 here, and we lost 60 here. Our net pips was 100 pips, and our net pips was 10 pips. But our profit is the exact same, $50. So why, right? It's because of our risk percentage. we're risking the same amount. So if somebody says, oh, I got 100 pips in the market, that doesn't mean anything. For one, it doesn't mean that they made a whole bunch of profit. And for two, it doesn't mean they're a profitable trader. And we'll get to that in a moment here next, okay? So let's, so to sum this up, what more movement equals more dollars? It depends, right? It depends. If we had 100 pips with this risk or with this lot size, then yes, that 100 pips would be worth more than that, right? But we determine this based on our risk percentage. How do we determine what our risk percentage is? Well, that's putting the cart before the horse, so we won't talk about that quite yet, but we will talk about it later. Okay, so let's look at another scenario. High win rate equals more profit, right? You hear people talking about, I've got a 90-something% win rate. I've got, I win 99% of my trades, whatever it might be, and you think, wow, that person is incredible. They're a successful day trader. Right? And I'm showing you these things because if you know these things, when somebody tries to sell you some garbage, right, and they maybe they win at 90%, it doesn't mean that they're profitable, nor does it mean that they, for one, it doesn't mean that they're successful, and second, it doesn't mean that they're profitable. Okay, they could have a 99% win rate and still not make profit in the market. Okay, and so, what is worth more, 90% win rate or 70% win rate? Well, at face value, 90% is greater than 70%, so you would assume that a 90% win rate is greater than a 70% win rate, right? All right, so it depends, just like before. Well, what does it depend on? So let's use some examples. So we have that same $10,000 account, and we've taken 10 trades. Now, our first trade, the parameters here is 90% win rate. We win 9 out of 10 of those trades, right? Our risk to reward is 5 to 1. So that means that we have a 10 pip take profit. Our goal is going to be 10 pips, and 5 times that amount is what our stop loss is. Our risk is 5 times our reward. That's a 5 to 1 ratio. So our stop loss is 50 pips for a 10 pip take profit. The only way I get 90% on this trade is if I allow for at least 50 pips of drawdown so it can have room to come back and take 10 pips of profit. Now, this is a winning risk to reward with the win percentage of 90%. It is. It will win profit, right? But is it worth more than 70%? So our 70%, now on this one we're risking 2%. So we're actually, our risk is 2% because we're at a 90% win rate, right? And the probability of concurrent losers. We'll get to that later. Now here, because we're only winning at 70%, we have to use a smaller risk percentage. So that we're going to use at 1%. But our risk reward here is 1 to 1. So if our goal is the same as this one, 10 pips, then our risk is a 1 to 1. Then I'm going to risk 10 pips to make 10 pips. Okay? So let's look at how this breaks down. So first trade, 90%, and we risk 2% of our $10,000 account, right? So what is 2% of 10,000? It's $200. Okay? So if I'm going to risk $200 in 50 pips, then my lot size is going to be 0.4, which is $4 per pip. Because $4 per pip 50 times equals $200, right? So 4 times 50 is 200, and 200 is 1% of 10,000, or sorry, 2% of 10,000, okay? So that's our lot size. And I won 9 of those trades for 10 pips. That means I have 90 pips of profit. I lost only 1 of them for 50 pips, which means negative 50, and my net pips are 40. I won 40 pips at $4 per pip, which is $160, right? So I made $160 in those 10 trades. Let's look at our second one. Here we have 70%, and we're only risking 1%, so it's $100, right? And so if I'm going to risk $100 in 10 pips, then I'm going to use a 1.0 lot size, which equals $10 per pip, or increment of movement, which means 10 pips times $10 is $100, which is 1% of 10,000. Okay, so that's why we use that lot size. All right. So I took 7 trades and I won 10 of them for 70, or I took 10 trades and I won 7 of them for 10 pips each, which is 70 pips. And I lost 3 trades for 10 pips, and I lost negative 30. So my net pips are 40, right? I won 40 net pips after my winners and losers in that trade, in that 10 trade sequence. Now I'm risking, I have a 1.0 lot size, which is $10 per pip. So 40 times 10 is 400. So $400 profit. So let's look at the side by side. Here, 90% win rate, 70% win rate. Profit, 160 bucks. Profit, 400 bucks. A 70% win rate ended up being more than double what a 90% win rate is, right? Now, why is that? Well, because the risk to reward. Had I used, let's say, this risk to reward 1-to-1 over here, then this 90% would be worth more than this 70%, right? But in this sequence, I wanted to prove a point. Which one is worth more, 90% win rate or 70% win rate? It depends, right? And what does it depend on? Your risk to reward, your win percentage. That dictates your risk percentage, right? So in this case, the risk to reward directly attributed to the profitability of this trade versus this trade, right? So I want to make sure to point those out, because I think some people look at trading and they say, well, I want to learn how to take a whole bunch of movement, or I want to win at a high win percentage. That doesn't really matter. What you should want is to make a whole bunch of money. However you do that, whether it's with a 20% win rate or a 99% win rate, who cares? As long as you're making a whole bunch of money, right? Do that. Just make a whole bunch of money. The rest of this is just the mapping, and I'll show you. But don't let somebody convince you that just because they have one of these elements, 90% win rate, or they take a whole bunch of movement in the market, that they're profitable and they can show you how to be profitable, right? It's just math. And like I said, showing you this is going to give you the ability to not only vet us, vet me, vet what I'm telling you, but also vet anybody else that's telling you anything else, so that you know, because what you know is doctrine, not what I tell you. I can tell you something, but until you know it, it's just my words. It's not yours yet. But if I'm showing you facts, if I'm showing you math and science and how this stuff breaks down, then you can choose to accept or reject it. And if you've accepted it, then it's not because I said it, it's because it's just the way it is, right? 2 + 2 is 4. Doesn't matter if you disagree, right? 2 + 2 is 4. There are certain things that are facts, and facts are stubborn things. All right. So profit, there we go, 400 bucks. So does higher win rate equal more money? It depends. So we saw, well, on what specifically? Win rate, risk to reward, risk percentage. In other words, proper money management. Okay? This right here, I can talk for days about. It would bore you guys, but this is how traders in the industry are successful, is proper money management. There's bar none, and we'll talk a little bit about that as well. So all too often in life, we're told to do things properly, but seldomly given step-by-step instructions on how. And so this series that we're going to be doing here, this is the first part of it. We're going to break down the step-by-step of how, right? So one constant amongst all successful day traders in the world are that they all adhere to proper money management. So again, we'll have a session exclusively dedicated to that topic. So remember, you get what you pay for. If it's free, it's usually worth every penny. Sometimes it's worth less. All right? There are more scams in the industry than there are legit ones. Let's learn how to tell the difference. Okay? So that you don't go out there blindly, and you don't have to try things a million times and end up with empty pockets and still being not being any better for it, as a result of somebody that's trying to get one over on you, right? So let's prepare you, because again, this gives you the ability to not only vet others, but also vet what I'm saying, what I'm telling you right now. Have no misgivings. I have a program. Now, is it for everyone? No. As a matter of fact, we don't accept everyone. Right? We have a process for that, our Trader Light trial. And for those that want to trade our corporate funds, use our proprietary software, use our one-on-one coaching, you have to go through the Trader Light trial first. And if you see that it's a good fit and we see that it's a good fit, then we talk about accepting you into our program. So this is like Ivy League college, right? We don't just accept everyone, right? And believe me, it's not free. If it was free, it would be worthless to you. That which is obtained too cheaply is esteemed too lightly. Okay? So you've got to have some skin in the game. So I'm not trying to pull one over on you. I absolutely run a legitimate company, and we have thousands of traders that trade our money on a regular basis. On a daily basis, we're increasing those accounts, adding additional funds to those accounts. And on multiple times a week, we're opening new accounts for members that have gone through the program and are now going into the live market with our money, and we're letting them keep 80% of the profit. Okay, so I'm running a legitimate organization here. Don't get it twisted. But you will have the ability to vet what I'm saying, and as well as everyone else. And it's not like it's my opinion on how you vet it. It's just math. It's just science. It's just facts, right? So it's not like I'm trying to give you some type of bias. On the contrary, I'm just showing you what is, and letting you see that these things that someone may not have explained to you exist within the day trading industry, and that if you know about them, then you can tell the wheat from the chaff. You can tell which ones are full of it and which ones are actually legitimate, right? And you'll find, just like I've and many other traders before me have found, that most of it, and I'm not exaggerating, over 90% of it is garbage. It is. It's garbage. And if there's somebody in this or watches this video and you guys are a part of one of those organizations, I will challenge you publicly on this page to show you that your stuff is garbage, unless it's not, right? But if you're not adhering to money management, you're not adhering to proper exit strategy, risk percentage, all those things, then it is garbage, and I'll show you 5 ways from Sunday why it is garbage. And I'll throw that challenge out right now, and I really hope that somebody takes advantage of that. Somebody please try to call me on that, because I would love to do that segment. It would be awesome. All right, vetting education. Ask the following. What is the focus of your education, right? Because to that point, the focus of their education is whatever they want you to think, right? We take these trades, we make all this, this money. Look at how we, made these trades or whatever it might. Look at our trade setup, right? It's all about the setups. It's all about the tools. Right, it's all about the indicators. It's all about whatever it might be. Right, it's very specific to executing the trade, but not really specific to how you determine how to execute that trade so that you stay profitable. Right, and there's a difference there. Right, so what you want to learn the following: you want to learn proper back testing, and there is a right and wrong way of doing this. Okay, you want to learn proper money management and protection. So your targets and your stops, right? Where you want to take profit, where you want to exit, and the math and science behind that. Psychology of day trading. You will have these psychological facets that can disrupt your ability to be successful at day trading, right? Fear and greed and anxiousness, boredom. There's a number of things that can debilitate a day trader and cause for you to lose trades, because you start thinking more emotionally versus logically and sticking to your plan. You start deviating from your plan. All right. And then everything else, right? So you want to learn backtesting, money management, psychology, and then everything else, that is including the trade setups, the indicators, all that stuff, right? So now, if this is their focus, how can you got to take it a step further? How can you tell if the backtesting that they're asking you to do is proper, right? And then the money management is proper, and the psychology day trading, that one's simple. You can pick up a book on that, right? There's a number of them on psychology day trading. Matter of fact, there's a book called The Psychology of Day Trading. So definitely take advantage of those types of resources. Because it is definitely something that will benefit you along your journey as a professional day trader. And it's not something you want to figure out after you've learned how to day trade and you go live, right? You start trading with real money, because that's when the psychology kicks in, is as soon as there's real money on the table to trade with. Then the psychology kicks in, okay? And then everything else. So imagine you're building a house. What's the first step, right? What's the first step when you're building a house? Is it the foundation? I think a lot of times when people use the analogy of a house building, it's like you need to create a solid foundation. Absolutely, 100%. You need a solid foundation to build a house on, right? So is it the foundation? Is that the first step? No, that's not the first step. What about plumbing, right? You want to make sure that all the plumbing underground, beneath the foundation, and through the foundation, that's all there? Nope, not that either, right? What about electrical? You want to make sure electrical is there. Obviously, you guys know if those two aren't the correct one, neither is electrical. So it's none of the above. None of these are the first step. What is the first step then, right? If we're going to be building a house, what is the first step here then, right? Well, it's simple. The first step is a blueprint. You need a blueprint. There's not a home builder out there that would start a house, even if they've been building homes for 30, 50 years. They're not going to build a house without a blueprint, right? You need a plan. You need a plan. You need to know how you're going to execute your setup, right? After that, then it's all about the tools, right? Once you have the plan, then it's all about the tools that you use to execute that plan. And the better the tools, the more effective you'll be at executing that plan, right? So you've got your plan, and now you're going to put it into motion. So here are the steps. First, learn setup and back test it. So you're going to learn a setup, and then you're going to back test it, right? Because if you don't learn it first, then you don't know what to back test. So you're going to learn a setup, and you're going to back test. Now, there's specific ways to back test. Today, we will go over one really simple way of back testing, okay? The next is money management. So once you've back tested, you apply your money management so you know that it's going to be profitable. Next is know thyself. You need to know what your risk appetite is, what your personality is like, to determine what trade strategy is going to be best for you. A lot of times we want a certain thing, but it's not necessarily what is going to be best for us, right? We want to be able to take, look, let's face it, everybody wants to be able to take that trade that doesn't ever go negative against us and always wins and moves a huge amount for a large amount of dollars. Everybody wants that. So let's be real here, right? What are you capable of? Not only just with your approach, but your risk appetite, your personality. Some people like it when the market is moving fast because it helps them get in and out of trades really quickly, and it drives them crazy when the market's moving slow because they get anxious. And other people like it when the market's moving slow because when it moves fast, it makes them anxious, right? So what is it for you? And to determine that, sometimes it's just a matter of learning something simple, and while you're back testing it, figure out, and demo trading it or whatever, figure out, what are you most comfortable with? What do you feel like you're most comfortable with? Use other scenarios in your life where it was either fast-paced or medium or slow-paced or, high or low risk or whatever, and determine where your risk appetite is, right? And then the other is execute. Don't forget, this is the most important step after you've got everything. You don't want to be knowledge on ice. You're never going to figure everything out. Never. And it's okay. You don't have to figure everything out. Just have your blueprint, right? You don't have to know how to build every single house and building that's ever existed. You just need to know how to build yours. So have the blueprint for yours and execute. Don't be knowledge on ice. Have all this knowledge and do nothing with it. Once you learn your setup and backtest it, you apply your money management, and it applies to you, who you are as an individual, then execute your trade when the time comes. Every time it comes, right? Every time it's there, you want to make sure that and we'll get into this on a later segment as well, but you want to make sure that the times that you trade are good for you, not when other people say that the market is good. That doesn't matter, and that's another myth I should have put down in there. That doesn't matter. It doesn't matter if you can't trade in the mornings, especially with Forex, by the way. It doesn't matter if you can't trade in the mornings, or you can't trade in the evenings, you can't trade in the afternoon, or it's a slow time in the market, or it's a fast. It doesn't matter. Whatever time is best for you, that's the time you backtest for. And your backtesting will tell you how to trade it. It's a blueprint, right? Now, you want to form-fit day trading to you, not you to it. So you don't want to be like a fish out of water, always trying to adapt to something that doesn't fit you. You want to bring it to you and adapt it to you so that it works for you. It's not cookie cutter. It's different for everyone, right? All right. And then rinse and repeat. Do it all over again. Get another setup. Backtest it. Apply money management. Make sure that it applies to who you are, right? Your risk appetite, your personality, then execute it. And then you can do as many of these as you want, right? Maybe you only need 2 or 3, or maybe you want 10 or 15, whatever, right? Learn the setup, backtest it. Apply money management. Make sure that it applies, it adheres to who you are as an individual, and then execute it in the live market with real money. Okay, so I'm going to teach you guys a setup, and then I'm going to show you a really simple backtesting technique. Now, this is a simple backtesting technique. I'm not going to mince words here, and it is probably one of the least effective ways of backtesting, primarily because if you get to the end of your backtesting and the answer is not something that's profitable, then you have to go back and test all those parameters again with different parameters associated with them. So let me just give you an example here. Here's the things we're going to collect: the date, the time, the pair, what target, what stop loss, and then if we won or lost that trade, and then whatever notes we see are relevant. That's it, right? Now we're going to look at dirty pressure in this instance, which, by the way, we have backtesting 4 or 5 ways from Sunday, but we're just going to make up these parameters. Let's say a target of 5 pips and a stop loss of 10 pips. So this is a 2-to-1 ratio, which means at the end of this, we'd have to have at least a 70% win rate in order for this to be profitable, because it's just math. It's not because I said so, right? If I had a 70% win rate and I won 10 trades and I was using a 3-to-1, this would be 70, right? And I had 3 losers. 3-to-1 means my stop loss would be 30, right? This would be a 3-to-1 ratio, risk, reward. So this would be 90 negative, and that would be negative 20. A 3-to-1 will not work with a 70% win rate. A 2-to-1 is at most 2-to-1, right? If I had a 20 here, right? Because that's 2 times my profit, or better, a 1-to-1 or a 1-to-2 or whatever. But a 3-to-1 wouldn't work. So there are yeses and there are nos to this. You can't just decide where your stop loss is going to be. You got to let your data tell you, based on market conditions, based on a number of things. And we're not going to touch on that too much today. But I want to show you this. This is just now how far to backtest. The specifics on I can't cover all that right now. So we are going to cover it, but later on in this series. Right now, I'm just going to show you how to do it, right? The step by step, and then we'll worry about the finer inner workings at a different time. Okay, so you're going to first thing I'm going to do is I'm going to show you dirty pressure, right? Because you need to learn a setup, and this is using our proprietary indicators, but I'm going to use them as the example today to show you backtesting. So this is the dirty pressure setup. It involves the major impact and minor impact indicators, which are here, and the pressure indicator, which is there. And the first is for a buy. You want your majors pointing up, which are the green and red lines right here. And you want your minors, come on, there we go. Minors also pointing up, your minor impacts pointed up, and both of those pointed up. And your green pressure line has just arrived above the red pressure line. So we see that cross right there, green cross on top. And at that moment, we want to see all 4 of those lines pointed up. For a sell, it's just upside down, right? We want, for when this green is already on top, we want for it to have crossed on bottom of red, and all 4 of these lines pointed down. Now, we're going to use a 60-minute candle for this, just so we can ease into this process of backtesting. And let's look for that dirty pressure setup. So I'm just going to go back to, as far as this chart, I'll go back. Let's get rid of that stuff. Let's leave this one up. And I want to go to, so you can see here, just so I can break this down for you, see right here that sometimes the lines get really close together. Let me look for a better example. Sometimes these lines get really close together. And so versus me stretching it out with this here and having to readjust it, I just have a separate chart right here. And you'll notice if I move one of these charts, both of them will move, right? But on one chart, I only have one indicator, which is the pressure indicator, and it's the same as that right there. It's just stretched out. And then on the other chart, I have major, minor, the TNTs, and the pressure indicator. Okay, so what we're going to be looking for is that cross in pressure first. If green is on top, we want to wait for it to cross on bottom. If it's on bottom, then we want to wait for it to cross on top, right? So let's look for some examples of that. So right now, let's go back. Green is on top, and we want to see the moment that it crosses below red. And at that same time, we want to see all four of these candles pointed down. Now, don't worry, I haven't put it past you that some of you guys that might be watching right now have no idea what a pip is, have no idea what a candlestick is supposed to look like, have no idea about anything about day trading. All you know is that I'm asking you to tell me what these lines should look like. And that's it. That's right now, if that's where you are, then that's enough to identify this setup in the Forex market. You don't have to know anything else. That's it. Square peg, square hole. It's a systematic way of trading, right? And it's duplicatable. Okay? So green crossed on bottom of red right here. But these lines are not pointed down at the same time on that same candle. So we do nothing. We're not going to do anything there. Let's look for, we want green now to cross on top of red. Right there. Okay. So green is now on top of red. It's kind of hard to see there, but you can see it clearly right there. And at the same time, on that same candle, all four of these lines are now pointed up. Right? So right there would be, at the end of that candle, would be our entry. Now, by the way, for this type of setup and others, we send out notifications for these 5 minutes before the top of the hour. So right here, there's dirty pressure. Right, we'll look at that one. GBP JPY dirty pressure. So that was at 8:55 my time. So let's go to GBP JPY dirty pressure. Right there. Okay. So we can see green crossed on top. All four lines are pointed up. So right there, we would have taken a buy trade at the end of that candle. Right. So if you're worried that you have to have like a knee-jerk reaction, you have to be quick on the trigger. No, I mean right here, we gave you 5 minutes notice, and these come in mobile. We send them to your mobile device or on your desktop, and so you get that chime. You say, okay, I got 5 minutes. Let me go check. Yeah, is green on top? Yeah. Did it just get there? Yep. All four lines are pointed up. Perfect. Okay. When that candle ends, I'm going to press the buy button, and I'm going to set my stop loss and take profit based on however I tested. Right. So when I said that we're using the best indicators, we're using the best technology, I'm not exaggerating. I mean, we've got, and that's just the tip of the iceberg. And that one would have been just fine. Obviously, that went up depending on what your stop loss and take profit are. Okay, so right here, then we would have entered a buy trade, and we would have wanted to go up by 5 pips before it went down by 10 pips. Our entry would be right here, 1.20720. And our stop loss would be, our take profit would be 1.207. What did we say we're going to use for this? 5 pip take profit, 10 pip stop loss. Okay. So 1.20770. 770. And I'm just drawing these lines. Obviously, we would have executed this in the brokerage, whatever brokerage you'd be using, right? And then 1.20620 would be our stop loss. And don't worry about if you don't know how to count pips or anything like that, we haven't talked about it yet. We will in a later segment, but this is the backtesting is most important. So I wanted to first get you a setup that you can, or whatever it might be, but we'll use this as an example and then show you how we would backtest this. Okay, so we wanted to go to the blue line before it gets that red line on the next candle. It looks like it did both. Let's look at this play-by-play. So I'm going to look at a 5-minute chart. And let's go back here. And let's see which one went first. So this is the last 5 minutes, just to be clear. This is the last 5 minutes of this 60-minute candle. So the price is the same, so that's good. All right, so let's go forward and see if it went up the 5 pips before it went down 10 pips. So this is the next candle will be the first 5 minutes of the 60-minute candle, and it went up 6 pips and it went down 4 pips. So yeah, that would have been fine, right? So let's record that then. So did we win that trade? Yes. So we'll just mark 1 for win, 2 for loss. Okay. And on that one, we would record the date that it occurred. So right here, which would be 1/2/18 at 0900 UTC. So let's just do that right here, 1/2/18, and that's 1900 UTC, and this is UR. So let's just say all these are going to be Euro USD. And then target, all the targets will be the same. And did we win or lose, right? We won that trade. Okay, so let's go to the next one. Let me erase these lines. Okay. And then now that green is on, okay, so now that green is on top, we want to see it cross below red in pressure in this bottom indicator first, right, on this one. And right there, we can see that it crossed on bottom of red. It's hard, again, it's hard to see right there. I can stretch that out like that. There you go. You can see now it's on bottom. Let me erase my drawing here, my scribbling. So green's on bottom. And all 4 of those major minor lines are pointed down. So right here would be our entry for a sell or a short trade, 1.20696. We said we're going to go for 5 pips, so 1.20646. And obviously, if you're back testing, you wouldn't be drawing in these lines like I'm doing here. I'm just using them for visual aid for us today. And that's our take profit. So on the next candles, we'd want it to get to that blue line before it got 796 to this top line right here, 1.20796. And make that one red. Okay, so click forward. Boom, that one's fine. That one would have won, right? That one moved 10.4 pips, it only moved about 1.1 pip up. So right here, we won that one, right? And then we obviously want to record the date and time that it occurred. So this one is 1/2/18 at 10, right? Which means the other one was at 9, not 19. At 0900, and this one is at 10. And this one was the same day, 1/2/18, right? And then it won. All right. So now green is on bottom. We want to wait for it to go on top of red. Right there, green's on top of red. All 4 lines are pointed up, so we take a buy. And that one moved up 6.8 and moved down 2.1, so that one won, right? That would have been a winner as well. So 1/2/18 at 19. Funny. I mismarked one, and we actually have one on 1/2/18 at 19. All right, 2 and 18 at 1900. And that one won as well. Now, when we're back testing, so that's the kind of the general, right? I'm gonna rattle some stuff off to you really quickly because we've already taken way too much time on today's session. But I'm gonna rattle some off to you really quickly. Once you have your setup, here are the things that you want to consider when back testing. You want to do these things when back testing. So either watch this video and replay later. It'll be on my page, youtube.com/theprovingground, and this one's called Day Trading for Beginners. Okay. Now, first thing is you want to establish what times you're available to trade, not what times you want to or what times you think are best, but what times you are available to trade. So available, right? Availability. If you are always at work or doing something else, from 6 o'clock in the morning, whether it's getting ready for work or going to work or dropping kids off or whatever it might be, then that's not your time to trade. If you're still at work throughout that time, but you know that you get home, you have dinner, you do homework with kids, whatever it might be, you talk to the spouse or whatever, and then you're ready to sit down and watch television. Well, versus watching television, you can trade at that time. So you know I'm available to trade at this time. Let's just say for example it's going to be 7 p.m. to 9 p.m. in whatever time zone you're in. Okay, so that's the time that you're available to trade. Now, can you make a commitment to trading the vast majority of the time? If your setup occurs between 7 and 9, you're going to take that trade. If you can't commit to that, then that's not the time you're available. You only want to commit like a job. You're going to show up, otherwise you get fired, right? You want to make sure that if your trade setup occurs at that time, you're going to take it the vast majority of the time, okay? So what is your availability? You establish that, okay? And then you establish, now you already know your setup, and let's say you're going to practice it on the, backtest it on the Euro USD, okay? So EUR USD, that's the pair that you're going to be testing it on. And these are the times that you're going to be testing it for. You're only going to backtest for these times, right? Because the market moves in different ways at different times of the day, and different currency pairs move differently at different times of the day. They don't all move fast in the morning, or they don't all move fast in the evening, or slow. They all move in different times in different ways, right? So the reason why you want to do this is because you want to make sure that you're accounting for what the conditions are on the euro versus US dollar at that time, not any other time. And if this is the time that you're available to trade, then why are you going to be looking at any other time, right? So only if your setup occurs between this time do you gather the information and then and track it, right? And then on one currency pair at a time, okay? So in this case, we're looking at Euro USD, okay? And now there are certain things that you should collect, but we're not going to go into that today. Now, the other is how far back you go. The reason why our YouTube channel is called The Proving Ground, TPG, The Proving Ground. The Proving Ground is a definition of time. It used to be January 2015 to December 2019. Before that, it was something different. But since 2020, it is January. This is the proving ground, okay? This is where you prove out your setup. January 2016, okay, to the end of December 2020. From 7 and 9, if this is a 1-hour chart, from 7 and 9, every single trade day from January 2016 to December 2020, it's 5 years. By the time you're done, even if it's just a few of these right here, let's say on this setup, you probably have like 600 or 700 examples. And they'll take you about, after a while, you'll get to a point where you can collect them in 30 minutes or 30 seconds per example, right? When you first start, it'd probably take you a minute and a half. So if it's 500, then that's, 750 minutes. So break that down, right? It's like 10, 12 hours, something like that, right? So that's how long it would take you to backtest. But then you have your blueprint. Now, here is the drawback. If you guys were waiting for that, I don't know if we measured that already. Yeah. Okay, here's the drawback to backtesting this way, okay? Now, can it get you an answer? Yes, it can get you an answer, but usually it's going to take doing this multiple times, because at this point we just decided 5 pip take profit, 10 pip stop loss. We didn't really know what it could do. We didn't really consider what it could potentially give us for the time that we're trading. We just said that. So if at the end of it I have these winners and I have losers, let's say I got 500 examples, right? Let's say I've got winner, 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 and then I've got losers, losers, and then winner, whoops, so on and so forth, right? Well, if this does not equal a win percentage that is 70% or greater, then I can't use these parameters because it won't work, because I'm only at 70% at a 2-to-1. If it's 70% or greater, then I know, okay, I have my answer. I can trade this with a stop loss of 10 pips, a 5 pip take profit, and I'll win 70% or whatever percent of the time. right? And then I can start trading it. And if I'm winning at that, then I'll use this much risk in my account, and now I know what my lot size is going to be. You see how it's a whole plan? Now you know what your trade setup looks like, you know what your stop, when to execute it, you know what your stop loss and take profit are going to be, and you know what lot size you're going to use because you know based on this information how much of your account you're going to risk. It's everything you need to know, right? It's just a lot of back-end work at first. And this is the most boring stuff to most people. This is not exciting. Right? This is not like you're not clacking your heels right now. But if you get this done, you will be clacking your heels somewhere on a beach or fishing or traveling or doing whatever you want if you do it right. It's part of the reason why people don't teach this stuff is because, for one, it's boring, right? And for two, if they showed you this, then you would know exactly how to prove that what they're saying is wrong and it's garbage and it doesn't work. Because you can say, okay, I know how to backtest. So if you're telling me I can get X amount of pips with X amount of stop loss, I'm just going to go ahead and backtest it and see if it'll win at a winning percentage that would make profit. And if it doesn't, then you know they're full of it. So you may have to watch this video a couple times so you can get this stuff down, right? Now here's the kicker. Again, if you get to the end of that and this is not at 70%, right, you're not winning 70% of these, then you have to go back and decide on different target and stops, right? How many times might you have to do that before you get one that works? And if there's 500 examples and it's taking you 12 hours, I mean, the second time around is probably taking you half that time, but still that's, 6-7 hours every time you got to go back and check these again, right? So there's a more effective way of doing it. I'm just not going to talk about it today, but this will get you started, right? This will get you started at least practicing going back and looking at your setup. Why do we go back 5 to 7 years? Okay, I'm going to wrap up with this, and we're going to be done for today. Why do we go back 5 to 7 years? That's a long time. 5 years. Why do we go back 5 years? Well, remember what we said about day traders and it taking 5 to 7 to 10 years to be successful? It's because within that 5 years, usually it's in those 5-year increments that you can see just about every overall market condition occur. Uptrends, downtrends, bias in one direction, bias in the other direction, short-term consolidation, long-term consolidation. All of those things aggregately happen within that time, January 2016 to December 2020. Now, that accounts for the overall conditions. What accounts for the individual conditions? Well, the times that you trade and the currency pair that you traded on and the setup that you're trading. The setup accounts for the market condition, the currency pair, and the time account for that market condition at that specific time on that specific currency pair. And then the 5 years that you test through those give you that overall market condition. So you're accounting for all that stuff. I'm not kidding when I say this stuff is very scientific and mathematical. And we've got traders that barely know how to use a computer, some of them, and we've been able to teach them how to do this kind of stuff. We have traders that have never traded a day in their life and now are successful day traders doing it for a living. We've had traders that have been trading for 20, 30 years and could not figure out how to stay profitable, and now they're profitable. It's all walks of life. We've been able to take people and produce successful day traders, thousands of people trading our money around the U.S. And keeping 80% of the profit. We max funded $100,000, and they keep 80% of that profit. Great business model for us because we can put our money where our mouth is, knowing that our product works and that when people try us out, they know that what they see is good. When they go through our programming, we know that we can help them be successful. So much so that we put our money on the line for them to trade, and let you keep the lion's share of the profit that you make. All right, guys. I'm going to wrap up with that for today. I'm going to come back next Friday, and I'm going to kick out another one of these videos, the part 2 of this day trading for beginners. What is day trading? All right, so keep an eye out for that. If you want notifications on that, you can. After you've subscribed to the YouTube channel, youtube.com/theprovingground, just hit that notification button. Otherwise, if you don't want to be bothered by the notifications, just make sure to see us back here next Friday, same time. Thanks for joining us. Have a good one.